When India was recovering from the first wave of COVID-19, Times Network realized the need to focus on reviving country's economy. Along with Punjab National Bank, we launched the India Revival Mission series, which saw the biggest minds from across the country come together over a period of almost 9 months to chart India's revival strategy. Now, as India recovers from the devastating effects of the second wave of the COVID crisis, it is time again to focus on the best strategies to minimize economic disruption and plan for growth. Times Network and Punjab National Bank are bringing together again to present India Growth Mission, which will see thought leaders bring out their plans to debate and discuss and deliberate what will boost India's growth. And to kick off the series, I'm in conversation with a very special guest, Mr. CH S.S. Mallikarjuna Rao, Managing Director and CEO of Punjab National Bank. Now, he's one person who's got the pulse on the economy right. When we were in the throes of the pandemic, Mr. Rao on the same channel, on the same forum, did indicate that economy will come back, and economy has come back. So what's next now?
It is true. If you look at even the figures which are available at our end, as at the end of November, you observe that the economy is on right track. Now, when we say right track, we will have to look at what kind of measures the government has taken right from the impact of COVID first time when it came in the month of March 2020. Till now, at that point of time, not much of private investment was visible, but government has created an impetus through their expenditure. They have created even the consumption demand by putting money in the hands of the people through direct benefit transfer, and also providing guarantee for emergency line of credit, particularly for MSME. So there are multiple measures taken by the government over a period of time in the last 1.5 years, particularly on the onset of COVID. And all of these things have ensured that the worst is now put behind at this point of time when we look back. Now, the kind of figures what we have got at the end of November, not only related to GDP, even with respect to the growth in terms of industry, various segments, whether it is the services sector or industry sector or even agriculture backed by good amount of monsoon, everything is looking positive. That is the reason why the estimate given by RBI for GDP growth for the year ended March 22 remains at 9.5. In reality, it could be a little higher than that. Now, when it comes to the growth in credit, even the figures released by Reserve Bank of India are little positive and encouraging. Particularly the growth of scheduled commercial banks crossing more than 5.8 to 6%. And also segment-wise, if you look at whether the retail growth, personal loan growth, MSME growth or overall credit growth, it is very encouraging sign. Till recently, we were rather waiting for the private investment to come up. Now we see green shoots and there are inquiries from private investment, particularly majority of them coming in the infrastructure segment. You are all aware that Government of India has allocated good amount of money for infrastructure, whether it is a port segment, aviation segment or road segment, when they have declared the budget. Now we are seeing that many of the players are showing interest in undertaking the projects. So it is a good sign. And for PNB as well, we have done reasonably well at the end of September, and we are expecting the same tempo to continue by December. While considering our targets for March, we still have to step up our efforts in terms of credit growth, but we are on right track. So is the position with respect to the economy. So I can summarily say that the economy is on right track. It is in a positive trajectory, and expected growth potential which is visible today, definitely we will achieve by March 2022.
Where do you think demand is coming from? Working capital, capex, and do you see banks participating in that, considering that a lot of large corporates, for example, the steel sector, the cement sector, some of these sectors have large cash flows. So while they're expanding their balance sheet, they're not coming to bank for fund requirement.
While I would agree to a certain extent what you are saying with respect to the participation of banks in terms of the quantity as to how much we did earlier and what we are doing here, it is good for the economy when there are many players for lending, when there are many opportunities for somebody to access the credit. It is always good. It will create more depth in the economy, more maturity in the economy. Now, coming back to what corporates have done in the last 1.5 years, they have also deleveraged in terms of their debt outstanding by way of participation in their equity from abroad through FDI or even domestic sources. It is also a good sign because debt burden in future as well under tough circumstances can create trouble for the corporates. So it's a good measure what they have taken. Second, as you rightly said, there are various other opportunities for accessing the credit either by way of debt through bonds or even FDI, but it is good for the economy. If you look at in particularly infrastructure lending, where the lending duration or the duration of the project is more than 15 years, dependency on only commercial banks will not be a better proposition in terms of any economy. If you compare with even developing economies in the Southeast Asian nations, there are many nations where they brought about the bond culture for funding the infrastructure projects. So if an infrastructure project is coming up, if the opportunity is there for accessing credit from multiple sources, it will create equilibrium in the economy. Similarly, what we are looking at, if you look at kind of potential, road segment is showing wonderful potential, and even aviation sector with the kind of impetus created by the government to prop up with various airports in the tier 3, tier 4 centers or tier 2 centers, it is an opportunity. And through private and public participation, it is a wonderful opportunity for developing these. So the potential being available, even though because of COVID there was little amount of impact on particularly aviation sector and tourism, but we're expecting it to grow in a very multifold in terms of the turnover manner. So because of these reasons, these infrastructure segment will definitely grow. While opportunities are there to access the credit from multiple sources, there will also be an opportunity on the part of commercial banks for lending.
So how is the current credit cycle different from the previous credit cycles?
See, if you look at the earlier cycle, predominantly between 2002 and 2007, the kind of investments which have happened in infrastructure were majority in 3 sectors. One is road segment, second is steel within the infrastructure, and next one is energy, whether it is state-owned companies or otherwise. And that was the time when there was a growth which we had seen in solar energy and other things. Whereas today, if you look at it, is a multi-dimensional infrastructure, even logistics, even if you look at in agriculture or agriculture-related activities, it is the warehouse development and it is the cold storage development. And the road segment anyway is in progress, having achieved the Swarna Chaturbhuji, that is a golden quadrilateral, and also looking for Bharat Mala. There is enormous potential. If you look at those kind of investments which happened in 2002-2007, have brought dividends at this point of time through toll collections, efficient collection of toll in various roadways. Roads are developed well and they are maintained well at this point of time. So it is a growth story, though there are various learnings out of that because of different reasons, and those reasons were plugged by the government, whether you call it as a minimum import price in terms of steel or even anti-dumping tax. In case of road segment, availability of single window for approvals and HAM model, hybrid annuity model being introduced by NHAI. The learnings out of the corporate lending to infrastructure during 2002-2007 have been very good, and accordingly the policies have been changed. As a result, today we look at smoothly the kind of lending towards these sectors. That is the reason why the cycle this time with respect to infra lending will be much more better, much more pronounced in terms of focus in various areas, and we don't see the negative impact of stress coming into these sectors in the days to come.
Will there be a challenge in lending to the entire MSME and SME space? And the reason why I ask you this question, Mr. Rao, is because that is one space where this entire migration of unorganized to organized, migration of large to big and big to mega seems to be hurting them. Big companies have technology and they have ability to scale up, whereas some of these MSME and SME companies may lack on that front.
First of all, there is no challenge in terms of lending to MSME. In fact, that is the requirement in the country at this point of time. However, whenever there is a catastrophic situation arises in the economy like of COVID, bigger companies will be in a better position to sustain even if the impact is there. But the sustainability on the part of MSME is only very, very difficult. That is what we have seen in the last 1.5 years where stress has built up in the MSME. Even if you look at theoretically the growth of corporate industry, ultimately they also require their backward linkage, what we call the supply of raw material or otherwise, for which they will be dependent on either on ancillary industry, which are MSME, or even divergent MSME industry. So if it is so, it is not possible for the country to completely depend on import from other countries in terms of the supply of raw material for the large corporate, which may not be a good proposition for the country. That is the reason why the government has started what you call vocal for local and also Make in India campaign. The point is, more focused approach in terms of handholding with MSME is a critical requirement. That is the reason why the measures taken by the government, number one, what you call guaranteed emergency line of credit, that is one. Second, production linked incentive. The incremental production, what you call increase, whatever they are getting, the linked incentive what they have created to various segments is a wonderful initiative by government to protect them against any the variance in terms of competition for cost of sales. So these are all very good decisions taken by the government, but they'll play out over a period of time. Overnight it will not do. Already we have seen good amount of impact of this PLI on various sectors in the last 6 to 12 months. So what we are looking at is, while critical mass in growth will come from the corporate segment, we need to be very conscious and focused in terms of the growth in MSME as well, which is very critical for the economy of our country in nature, not only in providing the employment, but also creating a sustained canvas for MSME growth in the country. That is very, very critical. Corporate lending will always provide you critical mass, that is at the volume level, very high growth is visible. Figures are very good in terms of visibility while lending, but we cannot undermine the requirement and necessity of growth in MSME sector in our country.
Right now things are looking up because of land reforms, labor reforms, low interest rates, but could inflation and a sudden tightening from RBI spoil the party?
See, low interest rate is the requirement under the current circumstances. There are two important measures taken by the government. One is government in fiscal policy and RBI in monetary policy. These two things have contributed to increase the consumption demand and credit growth because of low interest rate. That is very critical for the growth of economy or growth of GDP. Now coming back to the period up to which this kind of a situation will sustain, you must have seen in the last many more than 6 to 7 credit policy declarations by Reserve Bank of India, while they have reduced the repo rate starting from February 2020 till December 2020, since then they maintained the status quo of the repo rate, besides pronouncing the accommodative stance in order to send a very sentimental signal. Besides, they have also brought good amount of liquidity, very high liquidity in fact, much more than what is required for the economy, almost 2.5 to 3 times of the requirement of the current economy of our country. This was only to push a possibility of reduction in the rates in such a way that credit growth will take place. Now with respect to the concerns related to inflation, the situation currently what is there in terms of interest rates will not be a permanent in nature. There would be some element of correction which would take place based on the policy pronouncements by RBI. Market was expecting that in the month of December or February, when the RBI comes out with the policy, there could be some correction or there could be some increase in the repo rate. However, considering the now latest bout of Omicron, virus, I expect that RBI would maintain the accommodative stance in December. However, in the days to come, probably in February or April, there is an expectation that some element of maturity will come in interest rates on two counts. One is the liquidity will be reduced. Already RBI started reducing liquidity through variable reverse repo auctions started in the month of October itself, and 9.5 lakh crore of liquidity was available, which is slowly getting reduced. Anything around 2.5 lakh crore to 3 lakh crore of liquidity would be sufficient in the economy. When such a situation arises, the interest rates will become stable. It will not go down. Maybe a little amount of hardening can happen, but not very high. That would be a matured position in terms of the economy. So it will be helpful even for controlling the inflation, not only the interest rate, even other measures what RBI and government take, but also control the kind of lending rates, stabilization for the credit.
So Fintech is the new revolution. It is changing everyone's life and also our habits. Now that PNB's house is in order, would you be looking at expanding in that space?
Definitely, that is the order of the day. No longer we can count upon any bank size in terms of branches, in terms of the transactions undertaken at the branch level. Today, if you look at transactions undertaken at the branch level, are almost getting by converted as a back office transaction rather than a front office transaction. Earlier, we used to call front office transaction and back office transaction. When we say front office transaction, customers coming to the branch and undertaking the transaction. That no longer can happen in the days to come, because customers are looking at a convenience in terms of undertaking transaction, not only in a vanilla manner, but every segment of the customer has a different expectation. And the kind of transaction authorization is now shifted to the customer. A customer can go to ATM, complete the transaction and take the cash, or customer can do digital transaction through corporate website, or even through internet banking, mobile banking. As a result, there is no longer dependency on the employee of the bank for completion of transaction. This is the order of the day. This is the order of the banking for the future. And fintechs are critical cog in this entire system. The reason is transactional banking is the edifice for the entire banking, and based on that, we need to have fintech collaboration through API Connect for creating different user-friendly application interfaces for different segments of the society for reaching out to them, whether they are exporter customers or MSME customers or even retail customers. Depending upon their requirement, they won't visit the branch. They will be having an interface which can be accessed at their office, in their office, or through their personal mobile phones, or through their laptops. What they require, they would be inputting there, and the transaction should be complete. So fintech collaboration, while I've given only a simple example of as to how fintechs can completely change the way banking is done, there are many more dimensions the technology is providing. So what Honorable Prime Minister has told yesterday is very relevant for the years to come for the banking. Already we have seen this kind of change across the globe in various countries, and India is no exception. In the days to come, the banking will be known not in terms of the size of the bank will be known not in terms of number of branches or employees, but in terms of the volumes they handle through digitalization, not in a traditional manner. I am sure that PNB also will be definitely moving in that direction with the kind of investment we are proposing in technology and digitalization.
But can I safely say that PNB is back in growth mode? You're no longer looking at conserving your balance sheet, you want to expand your balance sheet.
Definitely, PNB is back in the growth mode, and it will remain. While the challenges continue to be there, but we have developed the capability to overcome the challenges, whether they are external or internal. When I say internal, we have already done the amalgamation, we have already done various other activities related to technology integration, and we are looking forward. And we have also identified the changes which are required to be done in terms of upgradation of technology, in terms of upgradation of digitalization. We are on the path in terms of that. With respect to external factors, we are seeing the COVID impact on our back, and we are seeing with positivity in the days to come. So we are back into the positive trajectory. While the challenges are there, we are confident of overcoming them and to move forward.
There's a big change in the PSU landscape as well. Mergers are at play, consolidation is at play. How will that change the landscape of the PSU banking space? There were over 24 banks, and now suddenly there would be 3-4 large banks.
Definitely, the benefits of consolidation will be available immediately. There are two important parameters for you to judge. One is the capital adequacy ratio of the banks, where after merger there are 12 public sector banks today. Second is the appetite for lending. And third one is the demand availability. These are the three important factors. Whether as a bank, if I have an appetite and demand is available, if my capital adequacy is not supporting that, it is not possible for me to lend. So all the three dimensions today are appearing very positive. You look at the capital adequacy ratio of all the public sector banks, they are very comfortably placed. If you look at the Punjab National Bank position at the end of September, our CRAR ratio was 15.21 as against the requirement of 11.5. Very adequately placed. And we have recently taken Tier 2 bonds, and we are looking at 81 bonds as well. So the market confidence on the banks, public sector per se, and bigger banks in specific is very good. So capital raising is not a challenge. And capital raising is required for growth capital in terms of showing growth when the demand is there in the economy. So because of that reason, because of the consolidation, they brought bigger banks. Government has ensured that bigger banks have come where the appetite is more for lending and adequate capitalization is available to them. There is no longer dependency on government for getting the capital. These are the very positive factors, and this will take us to a good position in terms of lending in the economy.
Walk us through what is the update on the subsidiaries. Would you be looking at investing a lot in your subsidiaries? Is it time when you really want to grow your subsidiaries as well, and there is no capital requirement for your subsidiaries also?
No, but the growth required at the subsidiary level also, there is no shortage of capital. If you look at even our subsidiaries, they've got enough capital. In fact, the insurance industry doesn't require any capital at this point of time. So they are all closely held. They are not even listed companies. For example, PNB, MetLife or Choice, both are doing very well. It is only a matter of external factors. Because of COVID, there was an impact on the growth in terms of insurance business, but it has picked up since October onwards, and I'm sure the insurance business will grow very well, though the profits were constrained because of more claims. But then 22-23 will be much better because of the consciousness of taking a policy in our country on the part of every citizen is clearly visible as on today. So insurance industry will grow well. Housing finance industry as well will grow well now after a lull of a subdued growth in the last 1.5 years. Even that company is having good capital adequacy ratio as on today, while they will be looking for opportunity in the market. So I don't think there is any pressure in terms of the non-availability of capital. It is a matter of time to go for the increasing the capital. In terms of PNB, we are sufficiently capitalized, as I have already indicated, and still we are looking for any opportunity. We have done 2 tranches of QIP. We have taken 3-4 tranches of Tier 2 capital acquiring from the market. We have done 81. We'll be doing 81 as well. So we are protecting ourselves in terms of capital to see that we will not be constrained when the economy growth triggers us at least anything around 10 to 12%. Currently, we are looking at 6 to 8% for the March 22, but we are ready with the capital to see the growth anything between 10 to 12%. So that would be better for the economy, better for the PNB.
Large part of the revival for a bank's balance sheet would be when bad loans, they become good loans. Are we at the beginning of that cycle as well, where instead of write-offs, you will see write-backs?
See, in case of steel, all the mid-segment industry in steel, in terms of the investment, they've come back to normalcy very fast. And those which are settled through NCLT or IBC are also doing extremely well in case of steel industry, whether it's a Tata who has taken over Bhushan Steel, whether it's a JSW who has taken over Bhushan Power, they're doing extremely well. Their EBITDA is very well. Now steel prices are very good. So every industry, when it was bad, when it is settled or resolved through NCLT on a particular situation basis, is doing extremely well now. So we are not expecting any fresh stress to be visible in case of steel industry. So also the cement industry. Cement industry and steel industry are directly linked to development in infrastructure, which we are seeing very aggressively in the days to come, years to come. As a result, these two industries will do. Not only these two, even in case of energy as well, while there are still some issues at the state government level in terms of the pricing for the to be collected from the citizens, otherwise the energy sector as well, the potential is very high. We are moving towards renewable energy, and potentially still very huge in our country. So in the years to come, with a little amount of correction probably at the price of power, everything can be put in a very good place even for energy sector as well.
When we spoke last, you were cautiously optimistic, and my sincere compliments. The world was falling apart. You said, look, I'm confident of growth and things will look up. But now that growth is evident, can I say that rather than being cautiously optimistic, you're confident of the next 2-3 years of economic trajectory?
Definitely. See, even at that time when I was speaking to you people, I was indicating that the human behavior cannot be frameworked through any formula. Economic formulas will indicate based on the situation as on that day. And since the situation was appearing very difficult because of COVID, the expectations were also on those lines. But human element is very critical because you can't keep his entrepreneurial skill, what we call animal spirits, under control for a longer duration of time. They'll be waiting for any slightest opportunity to come back with lot of vigor. That is what we have seen in the economy. Even pent-up demand in October 20 was very good, which was of course little amount of impact was there through COVID wave 2. Now even this festive season we have seen good amount of demand. because of the COVID vaccine coverage in our country, the fear has come down. So I am very much confident in terms of the growth of our economy. It is not cautiously confident at that time, but today I am very confident that not only during the year ended March 22, but in the next 2-3 years, India will be on top in terms of growth in GDP, growth in economy compared to any other country because of the potential available in our country for consumption particularly.
So, which sector will lead this entire credit cycle? Last time when we saw such a credit cycle, power companies were expanding, cement companies were expanding, infrastructure was getting created.
See, this time again, those things are already there, but then logistics, supply chain, these are going to define, because the more and more fintech is involving in banking transactions or economic transactions, it is a matter of logistics which will rule the vertical system, because the delivery at the doorstep of the customer for his requirement, whether the retail or even corporate space, as well, the kind of raw material supply and other things are dependent on the kind of logistics which get developed over a period of time, and we have seen development of infrastructure supporting the logistics. So these are going to define the vertical future. I am also expecting agriculture growth in terms of investment, in terms of other than traditional growth in a very aggressive manner in the years to come.
How do you see the retail experience moving? Because the pandemic has taught us importance of working from home, using more technology. Nobody wants to go to Fekit branch, even ATMs now.
No, it has already changed. It is not that very changing. It has already changed, because in terms of retail, if you look at predominantly the loans which are sold, or the products which are sold, are housing loans and vehicle loans. If you look at any bank as on today, if you segregate the retail segment, out of that major contribution comes from housing and vehicle. These are the two very high potential possibilities in our country because of the population, because of the people who are upgrading themselves from the middle class to higher middle class, or lower middle class to middle class. So these are the two factors where potential is available. COVID has only dampened their spirit. It is not that they were not having cash surplus. It is that they wanted to preserve the cash for any unforeseen eventualities. That is what has happened in the last 1.5 years. But now people have got confidence. They are looking for utilizing their surplus for satisfying their requirement in terms of acquiring housing loan or even vehicle loan by taking the loans. They are confident that it can be taken care of their future. So major retail growth will be triggered, even though we have seen good amount of percentage-wise growth in personal loans. But the critical mass, if you compare with these two factors, is low. So personal loans also will grow. So these are the three main ingredients for the growth in retail, which will trigger because of the potential available in our country.
So what, to your mind, are the forced changes which every bank is now adopting?
Right. Now, because of pandemic, what has happened, the last mile connect with the customer is the predominant factor, which is a learning for the bank. Until now, the thinking in the public sector space, even though we have changed in the last 5 to 10 years because of digitalization, still the DNA has been that customer will come to the branch and we can provide them the services. While this has undergone tremendous change in the last 5 years in metro and urban segment, but we see the change has come in rural and semi-urban, particularly because of pandemic. People have realized that they can satisfy their needs through digital mode under the conditions of lockdown. As a result, they having been satisfied with this kind of a banking facility, they now demand that the service should be delivered at their location. So the fundamental point is the last mile connect for the banks. No longer we can think of expecting the customer to come to the branch. So when we think that this is our objective, we need to completely change our model of extending the banking services to suit the requirement of last mile connect. That is where the fintechs will come into picture. That is where our extending the products through either mobile banking or internet banking or through collaboration through various BCs will come into picture. So that is the paradigm shift the COVID has brought about. Digitalization has been accepted by the entire country. It was earlier thought to be adopted by only literate, which has proved to be a wrong notion. Today, every citizen in the country is ready to adopt digitalization. That is the biggest learning for the banking industry in specific and economy in general.
Now that growth is making a comeback, Mr. Rao, what else needs to be done so that we do not do a self-goal and the momentum is maintained?
No, no. In fact, there are a lot of things which are required to be done. Today, we are talking about a sentiment and coming back of economy in terms of the growth. But we need to be also mindful of the fact that the base value as of March 20 and March 21, if you compare, for the achievements of March 22 will be based on March 21. So when the base value is low, the growth percentage appears very high in terms of GDP or even credit. So that we should be very clearly mindful. When we are mindful of that, the growth for 23 based on what we achieve by March 22 becomes very critical. And that cannot be achieved through sentimental understanding that the economy is coming back. It will have to be triggered through interventions in a multiple manner. The intervention will be from the government, intervention will be from the RBI, and intervention will be from all banks in identifying the sectors. So that is where recently, last month 17th and 18th, Government of India has conducted a meeting involving secretaries of various departments and brought on one panel industry representatives, all the commercial banks MDs and their other top management and secretaries were there in making presentations with respect to the potential available in our country related to infrastructure and the initiatives taken by the government through various schemes. So it is a very good forum, the initiative taken by the government. Now this forum will be followed up with the kind of groups and discussions in such a way that in the days to come there will be identification of the requirement of demand in terms of various industry so that visibility is available. It will not happen overnight for lending, but a pipeline will be created, and this pipeline should remain at least not less than 2 years in such a way that the lending should take place in a focused manner. And then only you can ensure that the growth in 23 and 24 would be on much higher panel, more than 9.5% what is predicted for March 22. Because 9.5% after achievement, you will realize that because of base value being low in March 21, it is good enough. But in 23 and 24, it should be much more than that. And for that, definitely there are interventions required from government, from banks, from RBI, and from the industry as such.
For India to become a $5 trillion economy, the requirement of funds would be high. Do you think currently PSU banks have that kind of an balance sheet and muscle to really do all the heavy lifting when it comes to providing capital?
Definitely, market appetite is there. Even AIs are also looking favorably, even though they are coming in a very smaller number at this point of time. If you look at the public sector space in terms of the government holding, still it is very high. In terms of PNB, we are at 73%. So we have the potential to bring it down to almost 52-53% within the existing guidelines itself. So if that is the potential of 20-23%, I can definitely garner more than 25,000 to 30,000 crores from the market without making any change in the current constitution of the bank or even the laws which are prevalent at this point of time. So the only dependency on market appetite. And in the last 1.5 years, you've seen tremendous amount of capital was raised by public sector banks. PNB itself has taken almost 6,000 crores through QIP and more than 5,000 crores through Tier 2 bonds. Similarly, Bank of Baroda, similarly State Bank of India, similarly Canara Bank. So if you accumulate take the total of all those things, it was a huge in the last 10 years, the capital risen by the public sector banks. So market potential is available. I don't see any reason why we cannot raise the required capital in the next 2 years for meeting the requirement of credit demand.
Yeah. So what to your mind is the risk to this economic outlook? Could it be inflation? Could it be tightening in terms of global liquidity?
See, the risk could be only the stress which is persistent in MSME sector, which has been under stress for the last almost, you can say 3-4 years, even much before the COVID impact has come. So there is a very close knit hand holding required with the MSME, and there is a window even created by the government as well on the lines of IBC code, even for pre-pack for the MSME segment in case of those industries which are not doing well for getting resolution through them. So there will be interventions required in a multiple manner from the government as well as RBI in terms of hand holding, particularly the MSME. So if you ask me if anything challenge is there, particularly after this COVID related relaxations given in terms of restructuring, in terms of moratorium, which has played out well as on today. As a result, these slippages have come down in the public sector space in the last 2 quarters. But we can say that we are completely out of it only maybe after 12 months time. having controlled the inherent stress still visible in MSME. In retail, I am not foreseeing any difficulty. So this is an important factor. This can be definitely controlled with the growth. The more and more growth comes up in the MSME, more and more lending takes place in an MSME, definitely there will be an impetus to reduce the stress. And that is the one with caution. In the next 1 or 2 years, all the banks will be working very hard. Otherwise, in the corporate segment, we have seen the stress which was there in the past. But as on today, I am not foreseeing any impact creating stress coming up in the corporate segment.
ESG is the big theme now, and we are getting a sense that globally banks are not really lending to a lot of non-ESG compliant companies. Do you see this becoming a big trend also in India?
See, as on today, if you look at related to ESG, the guidelines are not pronounced mathematically to convert into risk assessment while lending to the corporates. That is because it is a coming up phenomena. Every country across the globe is definitely rightly concerned about the environment, and that is how they are bringing these kind of computation to have a control in terms of the industry which is growing. Reserve Bank of India as well, if you remember last time in the credit policy, Deputy Governor has indicated, Mr. Mallikarjuna Rao indicated that they are also working on providing some guidance in terms of the ESG, which is a welcome. Now coming back to the status of our country, where thermal power still is predominantly ruling in terms of the power, we are also moving towards migrating to renewable energy. There is enormous potential in thermal power as well. We are having certain challenges in terms of availability of coal and other related factors. So the potential is available for migrating towards non-renewable energy, and the government is also working towards that. As I have told earlier, the only challenge remains in our country, particularly in terms of proper pricing for the power at the ground level. If that is taken care in a federal system of our country, I think the energy sector also will have tremendous opportunity. Potential is there for converting towards the non-renewable energy. Even the prices in terms of the cost of establishing a project in whether it is a solar or otherwise has come down, which is good for the economy, so that the ultimate price of power can be matching to the whatever manufacturing capability the unit comes up with a correction at the price being charged to the lower level in the federal system. It will do wonders in the energy segment. So I don't think any issue will arise in terms of ESG, but it is good for the entire globe, in our country as well. Though the guidelines are not available as on today, they will come. Once they come, even bankers, we will also take those factors into our risk assessment mechanism while lending to them, while pricing to them. But the impact will be more on entrepreneurs and the companies. So companies will have to comply. It will not happen overnight, but over a period of time, the incremental measures taken by them would be in such a way that it will not be creating any impact on the environment. So I'm expecting that the migration in our country as well towards complying to ESG requirements will happen over a period of time. Government is conscious of that. That is the reason why last time when Prime Minister has visited abroad, he had given a statement that by 2070, it will be a zero position in terms of the carbon. So coming back to even RBI, they are also very conscious. So I think there will be good amount of calibrated policies which would be coming up in the days to come, which would ensure that slowly we will migrate to a position in a controlled ESG manner.
Mr. Rao, an absolute delight to have you on ET Now. Thank you for partnering with ET Now, and thank you for supporting a mission on which we are committed to ensure that now that growth is back, how will the growth momentum be maintained?